Good evening, everybody. My name is Mark Sebastian. I am the founder of Option Pit. Option Pit is a full-service mentoring program. We have a chat room that's open all day. We do educational classes. We do one-on-one training, and we also do professional consulting. So I work with, we'll work with new investors that really want to learn what they're doing, all the way up to kind of consulting with managers about kind of what's in their book, things like that. We've had clients with as little as $10 and clients with as much as $10 billion. So we run the gambit, but you're getting the best with us. Just a brief. That's me. That's Andrew. We're the two big teachers. There's our director of software development, Sam. Good guy. Everybody's pretty awesome. So, yeah, well, I'm hoping you win a book too. We'll see. So I appreciate everybody being here. And with that, let's dig into understanding the VIX and the VIX ETPs. It's right now, it's 3 after 7. I will be done hopefully by 7:40, 7:45, and then I'll take questions. All right, I'm not one of these guys that's going to tie up your time. So what we're going to talk about is what is the VIX, the intent, what makes it unique, how the VX futures trade, how the ETNs, and then I'll actually share a trade I did today going. Andrew Giovinazzi, what are you doing here? Yeah, no, I'm kidding. So the VIX. The VIX is the SIBO Volatility Index. The purpose of the index is to gauge a buying and selling of options in the S&P 500. All right, that is what it is for. So that's the key. All right. So my friend Alex Jacobson likes to say that it gauges the cost of insurance. So how expensive is it to insure a portfolio? And the idea is that when there is more buying over selling, generally the market is trying to buy protection, and that's calls or puts. All right. And when there is more selling than buying, the market is not seeking protection. All right. Real simple. All right. When VIX is up, the cost of insurance is higher, and vice versa. So VIX up, cost of insuring a portfolio is up. VIX down, cost of insuring a portfolio is down. All right. Similar to the S&P 500, this index is not actually traded. All right. How could there be more selling than buying? By customer. So the question is, how could there be more selling than buying? By customers, not market makers. So, so it's really, what customer supply is doing. Right. So, you don't really think of the market makers market makers are the marketplace. They're not really customers. So, when you're seeing from the demand side more selling versus the demand side more buying, called the customer. So thank you for pointing that out. I think that's a really good thing to point out. Of course, there can never be more buys than sells in options, right? That's correct. So that's and so the idea is that when customers are out selling options, the VIX will fall, and when customers are out buying options, the VIX will rally. All right, so now a lot of people don't realize this, but there is legitimately absolutely no way to trade the S&P 500. All right, you can trade offshoots of it. You can trade the S&P 500 futures, which track it almost to the dime. You've got or to the penny. You've got SPY, which is 99% correlated, but is still not the S&P 500. You can trade the basket, but because of the way the S&P 500 is weighted, it's cap weighted, its weighting is changing. So there's no real way to straight up trade the S&P 500. Similarly, there's no way to trade VIX, but what's even more interesting is there's absolutely no way. Yeah, I'll cover that actually. There's absolutely no way to trade a basket of stocks that or basket of options that represents VIX. You can get close. All right, you can get, a variance swap will get close, but there's no true way to replicate VIX via a basket of options. All right. The VIX is essentially an estimate of implied volatility of the S&P 500 that has a net duration of 30 days. All right, it's got a constant duration. Constant duration means that it attempts to consistently mimic a portfolio with 30 days to expire. All right, so the portfolio never expires. All right, so that means there's a constant weighting of buying and selling of options in the index. And that's really kind of the crazy thing. All right, and all right, the weighting of the VIX puts more emphasis on at-the-money options and those trading near the money than out-of-the-money options. All right, the weighting of the VIX naturally puts more emphasis on puts, out-of-the-money puts, than out-of-the-money calls. So when you look at the VIX, really where the calculation comes from, it's majority at the money, then puts, and then calls, in that order. All right. I will. I'm absolutely going to hit that. Don't worry. Well, so the VIX is equal to one standard deviation move in the S&P 5. No. The VIX is the volatility, the expected volatility over the next 30 days. You actually use that volatility to calculate the standard deviation. It's close, but it's not exactly the same. Does that make sense? All right. So the VIX is, tries to replicate volatility. All right. So now, the way the VIX uses the two weekly options closest to 30 days to expire now. All right. This is the new methodology. In the past, prior to, I think like now, all right, I think they just started using this calculation. The VIX uses the front two contract months. So right now it would be using October and November. All right, and it would be weighting those, and it would run these calculations and then merge them together to create an index. Now that they're using, now that the options are only going to be using two weeklies around the 30 days, instead of having an option that had 8 days to expire versus an option that has as much as trying to think of 5-week cycle, as much as 43 days to expire. All right, as the VIX is rolling off, they're just comparing an 8-day option and a 43-day option or a 40-day option. All right. Now you're only going to be dealing with options that expire somewhere that have 23 days to expire up to 37 days to expire, or 38. All right. So because of that, what I think we're going to see is a slight downtick in VIX volatility. We're never going to have to, part of the calculation, and I'm getting into the weeds here for a second, is that under certain circumstances, when an option had more than 60 days to expire, we actually had, or the front month had more than 30 days to expire, we actually had to extrapolate the value down to 30 or extrapolate the value out to 60. All right? So the key here is there really won't be that extrapolation anymore. So what you'll see is A decrease in some of the weird distortions we see. VVIX is the volatility of the options, not the volatility of VIX. All right. So what you'll see is we think the movement of the VIX may decrease slightly. All right. Now, the real effect of this, all right, yeah, 23 to 37, you get an average, there's your VIX, right? So the real effect of this, and my understanding is one of the major reasons they're doing this is when does the new calculation kick in? I want to say if it's not this week, if it didn't just kick in, it's maybe I think it just kicked in on Monday. All right. Will they back calculate? So there's no way to back calculate because it is they didn't have weeklies up until whatever, but they believe it's going to have no effect on the actual VIX price at all. You know, that's their so I'll read the questions. All right. When did are the weekly options as liquid and well traded as the old monthly? They're starting to get there, especially front month. All right. Yeah, they're pretty tight, penny wide. They're not as tight as VIX. All right. All right. So if the extrapolation would just cause weird distortion. So his question was linear extrapolation has caused bias before what direction? It would just cause weird distortions of the VIX rallying and then dropping all of a sudden, and the futures never really moved on it. And the question was, not all stocks have weeklies. Yeah, but the S&P 500 does, and the VIX is only off the S&P 500. All right. All right. So I'm going to finish kind of hitting this question on the 30 days because I think it's really relevant here. But yeah, no, I'm trying to hit this 30-day thing. I'm not going to hit anything else besides that. So the 30-day thing, I think it will have maybe a tiny effect on volatility of the VIX. It won't have any effect on the VIX level itself, likely. But the big effect is that there won't be, where we will see effect in the cash calculation, is we won't have distortions related to the rolling of contract months. And that is going to make a big difference. All right. It also should reduce some of the weekend effect. Market begins October 6th, according to Macmillan. Thank you. All right, that I did not. So there you have it. It begins October 6th. But for your purposes, this is the way you should understand it. Because by the time you guys trade it, yeah, and you guys aren't going to calculate it yourself. The question is, forget the 30-day thing. You're not going to calculate yourself. That's correct. But understanding kind of what's going on. So if you notice that there aren't distortions around expiration, that will be good. I'll hit that up later. All right, so now let's move on. All right, so here's the two main contracts we would use. No, nor should you calculate the VIX. It's basically the calculation of a variance swap. All right, so right now the contracts that the VIX would be using are these two. All right, right now the contracts that I believe it's technically using, based on the fact that Macmillan says it doesn't start till October 5th, is the October that expires in 22 days and the Nov that expires in 57. But very shortly it'll move to these two contracts. All right. The VIX is quoted as a price, but it is really a percentage. All right. Volatility, despite not being spoken as a percent, is always a percent. All right. So a VIX of 14 is actually a 14% volatility. And this is why it makes zero sense, to describe changes in the VIX in percentage terms. All right. Anybody a fan of baseball? All right. All right. We all know what batting average is, right? The batting average, Derek Jeter is hitting, yeah, Derek Jeter is hitting 240, right, or 220, something terrible. All right. Now, if Derek Jeter gets on a hot streak and it goes 5 for 5 in his last game at Yankee Stadium, all right, and his batting average goes from 220 to, let's say, 228. All right, 220 to let's say 229. All right. Now, how would you describe that change? If his batting average went from 220 to 229, would you say that his batting average increased 4%, or would you say his batting average increased by 9 points? Yeah, it went up 9 points. Everybody's saying it went up 9 points. Right. Well, the VIX is similar. All right. So when the VIX goes from 14 to 15, it goes up 1 point. That is the only way to describe it. All right. You would never describe a change in a percent in percentage terms. Right? Your kid got an 80% on his last spelling exam. This time he got an 88%. Would you ever say, "Oh, son, your spelling percentage went up by 10%"? No, you'd sound silly. Your kid would look at you cross-faced. Right. No, this is how you can tell when people have no idea what they're talking about when they bring it up in percentage, that the change in percentage terms. And there are a couple of guys with goatees that like to do it regularly. I won't say who they are. Yeah, that's silly. All right. Moving on. So here is the VIX relative to the S&P 500. This is kind of a percentage, I wanted you guys kind of look at it in terms of how it can move. All right, in terms of returns. All right, now here's one I think is maybe a little better. All right, this is what the VIX has done in 2014. On the right is VIX points. On the left is S&P 500 points. And what do you notice? What do you notice? It's quite inverse. Yeah, well, one, it's pretty flat, and two, when the VIX is peaking and popping, that is when the market is selling off. So the VIX has a pretty large negative correlation. All right, the VIX negatively correlates with the S&P 500. When the SPX is up, VIX is generally down. When SPX is down, VIX is generally up. All right, this generally makes sense as when the market sells off, volatility does increase. All right, there's also the nature of similar movement against, there's the nature of movement against a lower number, right? So if I'm the S&P 500 and I move 10 points a day, and the S&P 500 is 1,000, right? My daily movement is 1%. Well, now that the S&P 500 is 2,000, and what is my daily movement? 10 points. Well, now it only moves 0.5%. So volatility will naturally and inherently falls on a rallying instrument, and falls and increases on a falling instrument, and that's on top of the increase in market volatility. So that's part of the inherent nature. All right. This makes sense, so in addition, there are some features with the VIX that actually cause the calc to kind of increase on a sell-off on its own. All right. Now, remember what I took. Does everybody know what volatility skew is? No. Volatility skew is so volatility skew is the relation of calls and of out of the money calls and out of the money puts to at the money options. All right. Now, what do you notice here? All right. You can see this is from today, right before the market took off for that final push. All right. You can see as we fall, put volatility is naturally increasing. All right. Every put strike lower has a higher volatility, and every put strike or call strike higher has a lower volatility, till you get to kind of just the insanely cheap stuff. All right. Now, do you remember how I described the weighting of the VIX? All right. Yeah, at the money options. Yeah, more weight on at the money options and more weight on puts than calls. So now, imagine that our at the money is kind of right here. Here, I'll put a pointer on. Where is that? Right here. All right. So now imagine imagine that we're trading here, and the VIX is, let's say, 14. All right. Now, the underlying drops, and this just moves along this curve. All right. And it drops to here. All right. So if the underlying falls from here to here, all right, how is that naturally going to affect VIX? Right? Think about it. Remember what I said, at the money up about 4. No, I don't mean, I don't mean, your at the money is higher even though volatilities didn't change, right? So think about it. The strike volatility of this option didn't change. The strike volatility here didn't change either. But volatility, the VIX is going to read higher. So that's one of the things you have to understand about VIX is that even if real volatility doesn't increase and option vols don't increase, the VIX is going to go up. So that's why it's going to correlate so well. All right. So, and that's really why you have to understand that the VIX is always not, it's not always the best, the best indicator of volatility. You really have to dig in and look at the S&P and look at the VIX futures. All right. So now, what makes the VIX so unique, right? If I asked you what the average price of the S&P 500 is going to be over the next 10 years, all right, then, what would you say? Yeah, you have no idea. All right. You might say, I don't know, 2,500. Now, what if I asked you the average price of the VIX? Well, then you should have an answer. All right. Over the next couple of years, all right, the S&P 500, you have no idea what the average is going to be. Now, the mean for the VIX would be 20. How's that possible? Mean reversion. All right, volatility, implied volatility, realized volatility, historical volatility, implied volatility, all are mean reverting. All right, they're all mean reverting. All right, and this means that over time it hovers around an average. So for the S&P 500, the mean implied volatility hovers to around 20. Now, there are a lot of people that would look at VIX and look at kind of the median, the mode, and look at it on a histogram and kind of where all the occurrences take place.
Make sure everyone can hear me.
All right, everybody can hear me? All right. All right, good. So my sound went. So there are all these guys that look at volatility, and you can look at the mean. But one of the problems with looking at mean is that the VIX has kind of a lower bound of around 10, and it doesn't have an upper bound, right? It went to over 80 during the financial crisis, all right, and it went to over, they back tested it and theorized that the VIX would have been well into the 100s if during the crash of 87. All right, so these spikes distort the mean, and so if you really look at kind of where the break line is between an above average VIX and a below average VIX, the answer is right around 17.5. All right, yeah, if you toss out the real distortion, the answer is around 17.5. So when you're looking at VIX and it's below 17.5, it's low. When it's above 17.5, it's high. All right, so right there, that should tell you something. All right, so this presents opportunities in the VIX if one is so inclined to trade VIX futures or VIX options. So when the VIX is above 17.5, it will eventually fall back. It could take a long time. All right, and when the VIX is below 17.5, it'll eventually rally. All right, and it'll eventually rally back to 17.5. All right, again, it can take long time. We've had the VIX below 15 basically for 2 years. Yeah, it can stay low for a very long time. All right. So really, the way I look at the VIX, it works in kind of two ranges. You've got kind of it oscillating around a near-term mean volatility, and then over that period, those near-term mean volatilities oscillate around 17.5. Key is understanding where you are in the cycle. All right. Now, one of the things that you really do need to understand is that VIX will stay below that 17.5 level for very long periods of time, and then it will stay above it for relatively short periods of time, 6 months, a year. All right. All right, and especially with all the privacy. So, any questions on how the VIX is calculated that are of immediate need to be answered? All right. So now let's talk about the VIX futures. All right. VIX futures represent 1,000 times the value of the VIX at expiration. They trade on the CBOE Futures Exchange. All right. It expires monthly on the Wednesday that is 30 days prior to the next month's settlement. All right. Now, if you think that sounds complicated, it was so complicated, the CBOE had to create a spreadsheet so that money managers could figure out when their VIX futures were settling. All right. VIX futures are European. Now, what does that mean? That means there's no early exercise on the futures. That is actually very important. All right. It is extremely important because now it allows the VIX futures to trade around some of these spikes. All right. Well, if the VIX futures were American settle, they would be impossible to trade in VIX spikes. Yeah, I'm about to hit this. Right. No, I understand ES, NQ, and YM are all can trade, but the thing you've got to remember is when the volatility has this mean reversion, are all financial futures are settled? No, ES, NQ, YM, and TF all settle into the future, and then on settlement they settle into cash. Yeah, they settle into cash. You're correct. I'm sorry, I was thinking of the options. So no, the options settle into futures, and then they settle into cash. But the ES actually settles, they settle into cash. But this is but those are all American, not European. So there'd be no way to trade if the VIX wasn't a European settled contract. There'd be no way to trade it in spikes because everybody would sell and take. Everybody would sell and take. Would be shorting. At those peaks. All right, or at the longs, at the long moments, everybody would exercise and collect cash, and then try and sell. The marketplace would break in sell-offs. All right, so they expire into cash based on a special opening Haas rotation on that Wednesday. All right, so now let's talk about some features of the VIX futures, and before we can do that, we'll talk about contango. All right. Contango is a market condition where back month futures are more expensive than front month futures. All right. When VIX futures are in contango, it represents that the market is more afraid of long-term risk than the immediate. All right. It represents that the fixed cash the market perceives that over the next 6 months, the VIX cash will be higher than it is currently. Yeah. So you can think of it that the market's more afraid of an up move than a down move in VIX. All right. And long-term expectations are the VIX is going to rise. VIX is in contango 80% of the time. And yeah, when things are in contango, this is what it looks like. And these futures have to slide. So if I buy this December contract and I hold it, and the VIX doesn't move, I'm going to lose 8 points by convergence. So VIX futures have a convergence theta to them. If you're familiar with options, there's almost a theta burn to that roll. All right, and it's not like S&P futures where the roll is based on interest and dividends. It's really based on market expectations of VIX. Holding VX futures is expensive, you don't get a rise in volatility. That's correct, or if you don't have a roll management plan. All right, so if I'm buying kind of a 4th and 5th month contract and kind of rolling back, that's less expensive, or if I'm doing some timed rolling. Or if I'm implementing my cash as VIX rallies. All right, those are all things I can do to really make the VIX less expensive to hedge with. All right, so now we're going to talk about backwardation. All right, that is a market condition where front month futures are more expensive than back month futures. All right, when VIX futures are in backwardation, it represents the fear that volatility in the near term outweighs fear in the long term. VIX futures are trading below cash. The market believes that over time, volatility is going to fall. All right, and this is extremely rare. All right, and actually, I think that contango number has ticked up to like maybe 85 or 88%. All right, so backwardation is extremely rare, but it is something that happens and creates all kinds of crazy opportunity. And actually, contango can be traded as well. There are people that legitimately just make money trading term structure. All right, so as time passes, traders using the VIX to hedge have to deal with the convergence of VIX to futures to conversion with cash. That'll be a huge drag on a portfolio if you don't have a roll management system in place. All right? In backwardation, it'll put a tailwind behind the futures contract, but those are short-lived. All right? Contango goes away, or backwardation goes away so quickly unless there is an absolutely extended sell-off. All right? So this roll decay creates a real problem. All right, contango backwardation is somewhere about 4 or 5 to 1 in terms of how often they happen. All right. Now, as I stated, there are people that put on spreads or short futures just trying to ride this down. Now, when there's too many people riding this down and we get a big VIX or we get an S&P sell-off, even that's just like 1%, you can see, what you might see in the VIX cash and the VIX futures is a short squeeze on volatility. All right, and that it can absolutely blow you up. All right, and yeah, there are absolutely strategies on playing term structures. Short futures can be dangerous. So there are, some strategies I've seen. I'm not going to dig in too much. There are guys that will kind of do spreads back in this range and ride them down. There are guys that'll do calendar spreads here. They'll do weighted calendar spreads. So there are some strategies that work. Guys that will use options instead of. I'm not even touching on options today. Think about that. All right, so there are definitely ways that you can do, and actually, which is funny because then I'm going to show you an option trade at the end that I did today. I would never do covered calls with VIX. The question is, can you do covered calls with VIX options on VX? I would never do that. Can I elaborate on the weighted spread? Yeah, you know what? Read about weighted Vega. Weighted Vega is this concept. Taleb talks about it. I've written a couple of pieces on it. And if you kind of read about weighted Vega, then I'll touch on UVXY. If you read about weighted Vega, then you'll understand maybe how some of these guys structure their ratio calendar spreads. I wouldn't sell VIX options against a long VIX. I think that's a losing trade. So maybe in a spike I would, but probably not in a regular environment. All right. Now, all right. Now, a market condition where front month future. Oh, yeah, we already hit that. Sorry. Duh. All right. So now let's talk about the volatility in the ETNs. As trading in the VIX futures has become more and more actively traded, each of the all these ETNs have come out. Each has a stated purpose. However, due to term structure of the futures, many of these ETNs have some unintended consequences that they knew they had. All right. So let's start with the VXX, which is the big dog. All right. VXX is the iPath S&P 500 short-term future. It attempts to replicate being long a VIX future with a concentration of 30 days. All right. The intent of the fund is to allow traders to get long or short near-term dated volatility without having to dig into the futures. All right. And then this fund does this by consistently rolling out of the front month and into the second month. So now, the Sisyphus effect. Everybody know who Sisyphus was? Rockman. All right, everybody tell me what he pushed, and I'll pick a random winner out of that. All right. All right, good enough. There we are. So let me stretch this out so I can see everybody. And somebody, Andrew G., tell me when to stop by typing stop. And the winner is Richard Warrington. I believe I've got your email. I will shoot, and your address. If you already have a copy of mine, then I'll send you a different book. All right, Rick. But if you don't hear from me, remind me, because sometimes I do forget to send it. So King Sisyphus thought he was really smart, and thought he could fool. So basically, Zeus forced him to, roll a ball up a hill, and then it would slide back down. Well, that's basically what VIX futures. That's basically what these guys are doing. In a contango state, all right, the VXX is constantly buying futures, riding them down to just near the cash level, only to sell at the bottom level and then buy a new future further out. This creates a major problem for the ETN because it's consistently selling at a less expensive future than it is buying a more expensive future. All right, the ETN has a limited amount of funds, thus it keeps reverse splitting. So if you ran a business where you bought a product for $16.10 and sold it at $15.50, you think you'd be in business for very long? You can short these, yes. No, you'd be out of business. And it can cause all kinds of problems. Now, it's dangerous being short these, but you can short these. So, and you have to understand what you're doing when you short them. So this is the result of this contract. And this is an old chart. It's gotten worse. I mean, think about this. The list price was something like $1,700, and now it's worth, at this point, it was worth $30. And I think it's lost more since then. This is not a good product to hold. So the VXX is slowly rolling itself to zero. It should not be held for more than a few hours if futures are contango. Intraday, it tracks really well and does what it should do. Interday, it stinks. All right, it's a good day trading product, and it can be used as a hedge against a falling volatility environment. So if you've got a portfolio that is long vol, VXX is a great hedge. It's just a poor hedge against rising volatility. Yeah. So if you had to do like Warren Buffett, you just short and come back 20 years later. That's correct. If I knew I wasn't going to margin call. So here are some similar ones. So you've got the VXZ, which is the midterm that's a little smoother and a little less problematic, and that is optionable. Then you've got the double long, which is UVXY, and TVIX. All right, UVXY is optionable. And XVZ, which is probably the best of the bunch but doesn't trade, is not optionable. UVXY has a additional little treat in there in that it is levered, so there's this daily recalculating. So as bad as VXX is, UVXY is worse. All right, and there's some things that I'm going to talk about in the next seminar, really digging into some of this stuff. So now the inverse is, the VIX, the inverse ETNs are theoretically going to infinity, but have a daily tracking issue that causes them to typically underperform being short the actual vol ETNs. So XIV is the reverse of VXX, ZIV is the reverse of VXZ, and SVXY is the double short VXX, and that is optionable. All right, and there are things you can do there. All right, so now I'm just going to show you an option trade that I did today and that I like. And, this one's going to be based on the fact that the VIX has a lower bound to it. I believe it is. I could be wrong. It's not one I trade. So the one thing to understand is that the point of this trade is that the VIX has a lower bound to it. All right, and the VIX is relatively low and volatility is high. All right, so the VIX is only traded below a handful of times. All right, and so here's a trade that I like to do when implied vol of VIX is high, so VVIX is high, and I think the VIX is going to fall, but I'm not sure, and I want to be and I don't want to play some sort of short call spread trade. It's called a bear 1x2, and this is a trade I did in October today, with my belief that the VIX was going to fall toward basically 13. All right, I bought the 10 of the 13.5 puts for 55 cents. I then put an offer out to sell the 13 puts at 35 cents. I sold 20 of them. So net, I bought the 1x2 at net. I bought the 1x2 for 15-cent credit. All right. All right. So here is the P&L graph. That's kind of what it looks like. So anywhere above 1235 at settle, I'm going to win, which would be one of the lowest settlements ever for the index. All right. Then I've got this big profit zone that I can play. And then anywhere above 13.5, you see I keep the credit. So this is a trade that I really do enjoy doing. The probability of winning, well, the problem is you can't look at the probabilities on Thinkorswim because they don't calculate this properly. But the probability of this trade is well into the high 80s. Yeah, that doesn't work. And Thinkorswim does not. You cannot use Thinkorswim to analyze VIX trades. All right, let me be very clear on that. All right, you cannot use Thinkorswim to analyze a VIX trade. Here, I'll show you. I can show you what it looks like in live vol, though. They actually can do that. Problem with the VIX, with Thinkorswim, is they still use the cash index for an underlying, and that is a huge problem when trying to look at this stuff. Let me get the forward date out to 21st. So here's kind of what it looks like. And what's the other thing that happens to VIX when it falls? You know what happens to the volatility of VIX when it falls? It falls. Yeah, the underlying needs to be VX. Is my VIX trade covered or naked? It is naked. If you want to do it covered, which is completely fine, you would go out and buy like the 11.5 put for a nickel. And then you're getting a dime instead of 15. Still like the trade. The trade I did was I bought the 13.5s for 55, and I sold the 13s at 35. 1x2. All right. And the probability of it being there, and again, you can't use Thinkorswim analytics for that because they don't take into account the lower bound of 1235, of kind of 10. You got it done early in the day. I did get it done early in the day. It was a great trade. What's the number on live vol? I don't understand. Oh. I have to look. Filters. Did they give me an odds here? They don't give me an odds. I'm sorry. So I'll just have to check that out. Probability is high. Back of my hand, calc, the probability of the VIX settling below 1235 is going to be somewhere around 10%. The live vol is free if you use it for execution. What broker do I use for VIX trades? I almost exclusively use live vol. So the reason why I couldn't show you this is because I have a bunch of other VIX trades on my actual live account, and I couldn't in live vol, and I couldn't separate them properly. All right, so there's obviously a lot of nuance to this trade, but the key is that I have this lower bound. It probably is success. I'm going to say about 85, 90%. And the real key is that if I hit into that profit zone, I can kill it. And because the VIX really does have a lower bound of what, like 11, you know, I'm going to lose. The most I could lose is maybe $1,300, and everywhere above that I win. It's a nice little trade, and it's one of my favorites. I do it pretty regularly, and I don't believe I've lost on one. All right, so I'm going to cover this trade and many other trades. I'm going to cover a lot of cool stuff on using options in the ETNs. I'm going to cover stuff on using the VIX options, all sorts of different trades on that. And we're going to cover it on our Saturday class, which is October 4th. All right. So Saturday, October 4th, Andrew and I are going to teach Andrew and I are going to be teaching basically a morning class, call it 2.5, 3 hours on the VIX. We're going to spend a bunch of times basically assume everybody's seen this so we can skip all the intro stuff. And then we're going to spend a bunch of time looking at how to play the ETNs, how to play the VIX options, and how to play a little bit. We might mess a little in the futures. All right, futures that's a real. And you go to optionpit.com/VIX primer, and the list price is $147, but I'm selling it at $47 for you guys. And I'll have this thing post to YouTube, so it's http://www.optionpit.com/VIX primer. All right, now, what was the question I was supposed to answer on the hedge? What do I think of the VIX as a hedge? I don't mind using. I think that there absolutely is a good VIX hedge on a short play. I think it absolutely can work. Not the ETNs, but call options for sure. One of the things that you'll notice is that a lot of the players in VIX are smarter than a lot of the players in the E-minis, and VIX futures will almost always lead the E-minis. There's a little tidbit for you guys that stuck around. How do you spell your broker? Live vol. Livevol. Well, think about it. Everybody and their brother is trading SPY and ES. Everybody with a pulse. You actually have to know what you're doing to trade VIX. Now, the VIX class is free for all current Option Pit subscribers. All right. So this is for the $47 price is only which is still dirt cheap, is for non-clients or people that are not currently paying for Option Pit. All right, and all classes going forward are going to be that way. Is this class recorded? Yes, it is, and that class will be recorded as well. You'll get the recordings, you'll get the slides, and the whole 9 yards. Yeah, we will send the recording out to everybody. Well, if you can do that, then now you've got something. The only problem with those probability of profits things, Greg, is that well, those might be VX options. Just make sure, and they may not correlate the underlying properly. So, and the other thing is that nobody really takes into account that lower bound. No, it doesn't. They tried them; they didn't work. It's going to be. It's not 9-5. 10-4 from. It's going to be 10-4 from 10 Eastern to about 1 Eastern. So we'll have you. You'll be done for lunch, and trust me, we will pack in a ton of info. All right. So the problem is that any analyst that does kind of probability of profit is going to assume that that there's a bound, that there's no lower bound except 0, when in fact there is a bound at about 11, currently, or maybe 10.5. That bound is key to the 1x2. How do you register if you're an existing client? I'll have it on the, you don't need to register. I'll have the link on the schedule on Saturday that you'll be able to see. So the number will be overstated. Yeah, understated. The probability of profit and the profit expectations will be understated. It is a good thing. And it's funny, you watch those Tasty Trade clowns. They try and use this on VIX, and they're always wrong. I'll send you the slides, but the trade that I've got on is the October put 13.5, 13, 1x2 put spread for a 15-cent credit. Please do something on directional option trading in the near future, please. I've done a couple of those presentations. If you want, I think I've got a few out on my YouTube channel. So is everybody signing up for this? And I'm going to show you how to use VIX options for direction. We're going to use them for non-directional. We may skip hedging, just because I feel like that's not what the audience is going to want. How would I adjust that 1x2 if I needed to? I wouldn't. I'd probably just close it, right? And I would wait till the very last day, or I'd wait till the VIX was like, even if it went to 11 with a couple of weeks to go, I would sit on it. VIX options are extremely liquid, incredibly liquid. They're probably, let me tell you, I'll show you what the volume is from today. Well, yeah, you got to know what you're doing to trade them. That's one of the things I like about them. So they traded 600,000 contracts today. Average contract volume is 528. Let's look at Google. Google traded 31,000 contracts today, and that's liquid. All right, so why is the spread on VIX options wide compared to SPY? Well, one thing to remember is most of these guys that are trading VIX are trading it. I mean, the market is much tighter than the 10-cent market. The spread's usually about 3 cents. You can get a lot of things done. Oh, it's Google. Yeah, it's Google, whatever that is. Yeah, I'm sorry. Apple. Here, we'll look at Apple. Apple does 780,000. But look at Apple. That's still wide. Yeah, it's all sorts of institutions buying big dollars out of it. Huge dollars. Can you talk about, you mean UVXY, not SVXY, right? I know a lot of people that buy XIV for an extended period of time. And really, the 10-cent spread, they're really about a nickel wide, and you can get a lot done. And they're just crazy liquid. Yes, the October thing will be recorded. Then I will. Hedging is something I use pretty often for VIX. I mean, and so I'll probably spend some time on that. But in 2.5 hours, I'm gonna try and cover everything I can. I've seen those videos on directional options and understand what you said about buying puts or calls when IV is low, especially out of the money. But can the VIX be traded in a similar fashion? Yeah, the VIX is way easier to trade from a bear perspective than a bull perspective, except for when it's rallying. One of the things about VIX is you just want to sell it and sell it and sell it and sell it until it starts rallying. Then you want to buy as much as you can. Is 1x2 put spread going to do better than just shorting puts? I think so. I really do. I've looked at kind of where you can short puts, and I've been pretty pleasant. Yeah, that's why I like these 1x2s, because you got a shot at really hitting a home run if it falls. Yeah. So especially, one of the things I like setting about 1x2s is that I can set it about where I think it's going to fall. So if I think VIX is heading toward 1275, that 1x2 is going to be an awesome trade. And I don't like selling call spreads because if the market blows up, you don't get because of the skew structure of VIX, you really lose a lot. I'll dig into that in the presentation. And trust me, I will spend 45 minutes I will spend a giant block of time looking at VIX option strategies, okay? All right, so the VIX percent of one standard deviation move from the S&P. No, the VIX is a percentage, is the expected volatility on an annualized basis that the market thinks the S&P is going to move for the next 30 days. You would then use it to calculate standard deviation. Oh, gold's just stunk. 14% would be a one standard deviation move in 1 year. That is correct. Would be the percentage move of that standard deviation. What is the average VIX move in points if the S&P moves down by 1%? It should move. It actually depends where the VIX is. So if the VIX is at 20, or something along those lines, it may not move very much. It might just move a point or two. If the VIX is at 12, it'll probably move 2 or 3 points. The beta of VIX is about negative 0.8. All right. Any more questions? Because then I'll let everybody go. Thanks, Dave. Yes. I'll talk about divergencies. I've done some stuff for Kramer on divergencies. If you want to see me talk about VIX divergencies, Google VIX and Jim Kramer, and you'll see some stuff. All right, everybody. I'm gonna call it a night. I've got more work to do tonight, and hopefully I'll see you all soon. Oh, correlation is 0.8. I'm sorry, not beta. Did I say point? That's the correlation, negative 0.8. Thank you, Rue. The beta is like minus 3 or 4. That's correct. Yeah, the negative 0.8 is the correlation. I apologize. All right, everybody. Hope everybody has a great day. I'll be emailing this out tomorrow, and I will talk to you all soon.